It began with silence, trading floors frozen, phones that once rang every second now still. In a matter of hours, the heart of global finance stopped beating. On September 15, 2008, Lehman Brothers, a 158-year-old institution, collapsed under the weight of its own ambition, and with it the world nearly followed. But here's the mystery: how could one company, just one investment bank, bring down the world's financial system? Was it greed? Was it corruption? Or was it something deeper, a flaw inside capitalism itself? To understand how Lehman Brothers' fall shook the world, we must go back to the roots of modern finance, to the promises that built empires, and to the moment those promises shattered. The 1990s and early 2000s were years of optimism. Technology was booming, home ownership was rising, and cheap credit flowed like water. But behind the scenes, something dangerous was forming. The global financial system was becoming a machine built on trust, leverage, and illusion. In the United States, Wall Street firms like Goldman Sachs, Morgan Stanley, Merrill Lynch, and Lehman Brothers were making billions from a new kind of financial engineering. The product? Mortgage-backed securities, bundles of home loans sold as safe investments. They promised high returns backed by America's most stable asset, the home. After all, housing never goes down in value, right? That assumption would prove catastrophic. Lehman Brothers wasn't born a financial monster. It began humbly in 1850s Alabama when three immigrant brothers from Germany, Henry, Emanuel, and Mayer Lehman, started a small cotton trading business. They sold crops, built connections, and slowly moved into finance, lending money to farmers and businesses. By the early 1900s, Lehman Brothers was a fixture of American capitalism, helping fund companies like Sears, Woolworth, and eventually the expansion of Wall Street itself. For over a century, Lehman thrived on one belief: that risk, if managed correctly, was the engine of growth. By the 1980s, that belief was supercharged by deregulation. Under Presidents Reagan and Clinton, old barriers between investment banking and commercial banking were dismantled. The message was clear: let the markets run free. And Lehman Brothers, like many, took that as an invitation to expand and to gamble. The early 2000s brought a new obsession: real estate. Low interest rates, easy credit, skyrocketing home prices. Everyone wanted a piece of the American dream, and banks were more than happy to sell it. Lehman Brothers became one of the biggest players in mortgage securitization, packaging home loans into bonds, selling them worldwide. The profits were staggering. In 2007, Lehman earned $4 billion in profits, and its stock hit $86 a share. Its CEO, Richard Dickfold, was hailed as a financial genius, a man who had taken a once small firm and turned it into a global powerhouse. But here's the twist. Behind those profits were hundreds of billions of dollars in high-risk loans. Loans made to borrowers with no income, no job, and no ability to repay. These were called subprime mortgages, and they were the ticking time bomb beneath the global economy. By 2006, cracks began to show. Housing prices stopped rising, foreclosures climbed, and the securities built on those mortgages began to crumble. Inside Lehman, executives reassured investors, "We're fine, the market will recover." But the numbers told a different story. Lehman held over $600 billion in assets, much of it toxic mortgage debt financed with extreme leverage. For every $1 of capital, Lehman had borrowed $30. That meant even a small drop in asset value could erase the company. In March 2008, a warning shot was fired. Bear Stearns, another investment bank, collapsed and was rescued by the government. Investors panicked. If Bear could fall, Lehman could too. Fooled insisted on strength, he refused to sell at a loss. Behind closed doors, the US Treasury and Federal Reserve began emergency talks. By September, Lehman's fate was sealed. Its assets were worthless, its credibility gone. On September 15, 2008, Lehman Brothers filed for bankruptcy, the largest in US history. The shock was immediate. Within hours, global stock markets plunged. The Dow Jones fell 777 points, the largest single-day drop at the time. Banks around the world held Lehman securities. Money markets froze. Credit vanished overnight. Ordinary businesses from airlines to car makers couldn't get short-term loans. The financial system, the bloodstream of capitalism, had seized up. In that governments rushed to respond. The US launched the TARP program, a $700 billion bailout to stabilize banks. The Federal Reserve injected trillions into the system. But confidence once lost is hard to rebuild. Lehman's fall was more than a bankruptcy. It was a collapse of trust. A moment when the world realized the modern economy was built on faith, not on safety. In the weeks that followed, public anger erupted. Why were taxpayers rescuing banks that had gambled and lost? Executives still received bonuses. Families lost homes, jobs, and savings. The phrase too big to fail entered the global vocabulary. Governments promised reforms, stronger regulations, better oversight. But beneath the surface, not much changed. The same institutions grew even larger. The same incentives, profit over prudence, remained. And while Lehman was gone, its legacy lived on. A warning that even giants can fall, and that the system itself remains fragile. 15 years later, the echoes of Lehman still haunt the world. In 2023, regional banks like Silicon Valley Bank and Signature Bank collapsed under pressure eerily reminiscent of 2008. Crypto markets crashed. Companies like FTX mirrored the same pattern: rapid growth, hidden leverage, sudden collapse. Once again, faith evaporated overnight. Once again, central banks stepped in to contain the damage. And once again, the question returned, did we really learn anything from Lehman Brothers? History suggests we didn't. Because every generation builds its own version of the same illusion that markets can defy gravity, that risk can be controlled, and that confidence will never break until it does. The fall of Lehman Brothers wasn't just the story of one bank. It was the story of an idea that markets could police themselves, that greed could fuel stability, and that innovation would always outrun collapse. We learned briefly that this was false. But memory fades, and the same forces that built Lehman are at work today: speculation, debt, and the blind belief that tomorrow will always bring more. So what can we take away? First, every financial system runs on confidence, not cash. When that confidence dies, even the strongest institutions crumble. Second, regulation and oversight matter not to limit growth, but to prevent destruction. Third, capitalism left unchecked will always push risk to its limits until it breaks. Lehman Brothers' collapse was a warning. But perhaps the real tragedy isn't that it fell, sir. It's that we keep building the same tower, hoping this time it won't collapse. This was the story of the fall that shook the world, and maybe, just maybe, it wasn't the last.